the thresholds. If they are meeting, obviously has to be a proper full version. But if they are not, that what kind of analysis have they conducted that their transactions are at arm's length. So, and this is something not only from a Singapore point of view, but this is from a global standpoint, that they want to ensure that whatever transactions are taking place are in compliant with all the kind of regulations, so that there is a consistency among the group per se. So there's a greater emphasis on the preparation of the maintenance. Uh, as I mentioned earlier, intercompany loan arrangements need to be very, very carefully analyzed with an appropriate interest rate. So that is something a very important, practical implication and a practical takeaway. So there has to be an interest rate. It has to be determined as per the procedures, and it has to be evaluated from a proper intercompany loan standpoint. Uh, the third takeaway is something which, this is quite important for a company having related party transactions, that apart from a documentation, there has to be supporting documents, like intercompany agreements, invoices, debit or credit notes, email correspondences, etc. Because these are the supplementary documents which are generally requested by during any proceedings, and they support the transcription documentation. It's like a cushion to the documentation, that if the taxpayer has maintained such kind of supplementary documents or supporting documents along with the primary document, which is the transcription report or a documentation, they give a lot of power to the taxpayer, that we have properly maintained all the documents which are required. And in the case of any TP audit, potential TP audit, they can also support the analysis conducted. So this is a good takeaway, and this would be a practical takeaway for companies, that there should be supporting documents also like these, specifically intercompany agreements and invoices and email correspondences are quite relevant for transactions involving management kind of services, because in TP there is a concept known as benefit test rule, right? So primarily it mentions that the taxpayer has maintained adequate documentation to support why it has received the services and what benefits it is getting from receiving those services, right? So that's why these supporting documents help a lot during these management services and any other kind of services. Uh, and as I mentioned earlier, TP documentation must essentially capture the required information, which is as per the amended guidelines. So whatever information is required to be mentioned in the documentation, that should be there, right? One of the example, as I mentioned earlier, information on government assistance received if applicable, and other takeaway which we would like to highlight is that there should be proper reasoning and justification for undertaking any comparability adjustment, like I just mentioned, working capital or risk adjustment, etc., or even any other self-initiated TP adjustment. That is, maybe a true up or a true down, or maybe at the end of the financial year you realize that the markup is not what has been agreed. Then there will be a self-initiated adjustment. So there has to be a proper reasoning and a commercial reasoning and justification, because the crux here is that the IRS cannot question the commercial reasoning. They will only ask how it has been impacted from the arm's length principle, right? So that's why, but there can be a situation if they ask for a reasoning, then the company should have at least some kind of logic that okay, why a comparability adjustment has been undertaken. Again, similarly, justifications or a reasoning, or at least some basic level of explanation or information to be given, that why a specific cost item has not been marked up, unless and until it's a pass-through cost. But if it's not a pass-through cost, then why a specific markup or any other pricing policy has not been charged. Uh, we have taken the markup example for simplification purposes, not including any specific item in the total cost base. Again, reasoning as to know why generally a specific operating cost item has not been included. If it's non-operating item, then still it can be explained. But if it's a core direct or indirect operating cost item, then why it is not being marked up. So this can be supplemented from the third point of pertaining to intercompany agreements. So if the agreement mentions about the cost base, that can support this argument of not charging any markup for any specific item. And again, justifications to be given while proposing any specific transaction to be covered in the MAP or advanced pricing agreement application. Apart from the justification, obviously there are the process for a MAP application or the APA application, which we had discussed in our previous webinars. But at least this is a practical takeaway for all of you, that there has to be a proper reasoning as to why this transaction is being covered, right? So this is what we wanted to discuss with you, because we wanted to keep it as short and crisp for all of you. But the main as a concluding remark from our end is that there has to be, first of all, a basic level of documentation to be prepared and maintained. B, there has to be supplementary documents which are there, whether it's agreements or any other email correspondence or uh, invoices, etc. And third, on the intercompany financing arrangements, especially the loan arrangements, that needs to be carefully analyzed from a transfer pricing point of view, that there has to be a proper analysis for determination of the interest rate, right? And apart from the four takeaway as a concluding would be to ensure that whatever analysis is being conducted, it is in accordance with the local requirements. So the group level documentation will not maybe work after as per the amended guidelines. It has to be in cognizance with the local amended guidelines, right? So yeah, that sums up our practical explanations for the guidelines. And we do have few minutes. I mean, we have, I think, a couple of minutes left. So if any one of you has any questions, please feel free to put in the chat box. We will be happy to take any question which you have. Okay, so I think we do have I think one question. So the question here is from Junhao Chan, that for capital transactions, uh, if IRS deem the transfer to related party not at arm's length, can IRS impose a surcharge on this capital transaction? So first of all, thank you for the question. So yeah, so see, if there is a disposal of any intellectual property, right? Uh, if first of all, the first point is, if there is a proper reasoning as to the sale, transfer, use, or disposal of the IP, right? If the IRS has been given this analysis, then they would still consider it to be at no arm's length, right? The second is, before the disposal, for the disposal of the IP or the intellectual property, they would first like to understand in the context of IP, there is a concept known as DEMPA, DEMPA, right? DEMPA analysis. So they will first like to understand who had performed the DEMPA, and then accordingly they will see as to know whether the disposal of the IP is purely from a administrative convenience point of view, or the entity who is disposing it had made some contributions in the Tempe analysis. So if, for example, if the entity is purely from an administrative convenience perspective, it is disposing, it is just involved in the transaction as a pass-through entity, then of course that will not be considered to be a transfer pricing adjustment kind of. But if the entity was the involved in the Tempe, then of course they can, and if they are not sure about the proper functions and the analysis conducted for the IP disposal, then they can subject to a TP adjustment, right? Okay, so the second question is, what is the threshold of the loan amount for the documentation of transfer pricing loans between domestic related parties? Like say $10,000 advance from a holding company, does that need justification or documentation to justify the interest rate, or need to apply IRS benchmark? Okay, so thank you for the question. So the threshold for the principal loan amount, right, what I mentioned earlier, is 15 million Sing dollars. Okay, now if it's, for example, if it's below 15 million, right, even then the IRS would be requiring a basic level of interest rate to be applied. So that's why what I mentioned earlier, that the interest free rate system or arrangement, it will not be considered to be at compliant with the arm's length principle, right? They will need some basic level of documentation, and along with the a proper interest rate, that okay, even if it's below 15 million, right? In that case, they would like to understand what is the minimum level of interest rate being charged, right? So the even if it's even if it's less than 1 million, if it's 10K, for example, in your case, then there are two requirements. One, as you mentioned, advances, right? So that has to be evaluated slightly in detail as to what kind of advance. Is it a fund advance? Is it a cash advance? Is it a loan? Or is it any other transaction nomenclatured as an advance, right? So first is we to understand the nomenclature and the contractual arrangement of this advance or loan, and then accordingly the appropriate interest rate has to be determined. But yes, the bottom line is that there will not be any interest-free kind of arrangement in such a case. Now coming to the third question, what we have is that how long do we need to maintain the supporting documents relating to TP or email and invoices? So thank you for the question. So see, as I mentioned earlier during the discussion, the transfer pricing documentation for a particular financial year. So we have a statute of limitation of 5 years, right? So for a particular financial year, like if we are preparing the documentation for 2024, we have to maintain and keep and prepare and maintain the documentation for that particular financial year for a period of 5 years, right? Similarly, for the next year, the documentation will be prepared, and that its statute of limitation of period of 5 years will start from 2025 and so on, right? But the emails and invoices are relevant for each financial year, right? So that is something to be prepared and maintained for each financial year. It's just like your statutory audit, right? For every financial year audit, there will be invoices which will be raised. There will be certain journal entries. So it's exactly the same that for every financial year, the emails and the invoices have to be maintained. It is only that the documentation is prepared for that particular year that needs to be retained by the taxpayer for a period of 5 years. But that will again not suffice that in the next year you don't have to do anything. You will still have to prepare to discharge your compliance obligation, but at least you have maintained a basic level of documentation for this specific financial year. So the bottom line is that for every financial year there has to be a basic level of documentation and a main kind of analysis which supports that financial year transactions. Because in every financial year, there could be certain transactions which have occurred additional or which are the same. But even for same transactions, that's why the IRS has given that you can do a financial update of your analysis. But the documentation needs to be reflective of the arm's length price for each financial year. So that's the main, point which we would like to emphasize on. Any other questions from anyone? And I think one question, I think maybe we have, could you share the document with us? Yes, we would be sharing these slides after the webinar. So if any other questions from anyone, we still have time, but if not as of now, please, reach out to myself for any further queries. So yeah, if any no other questions, then thank you, very much for your time, and giving us, the opportunity to provide you with a brief overview of the guidelines and the amendments. So the main crux here would be, or main takeaway from our perspective would be that there are certain benefits given to the taxpayer, but emphasis is still lying on the compliance obligation for maintaining a documentation and analysis for each year. So that is something which the companies must take into consideration, because of the fact that if the requirements are there and if they are not complied with, then there are no statutory penalties involved, etc. So to avoid all those elements, especially for the interest free kind of transactions, it would be important that this would be the best time for you as a company to evaluate your analysis and your policies and get going ahead with the transfer pricing compliance requirements, right? So thank you then everyone, to all of you, and we will be sharing the presentation after this webinar. And for any further queries, please feel free to reach out to us, and we would be very much be happy to take care of that, right? So thank you everyone, and have a good day ahead.